Right, good afternoon to everybody, and thanks very much for joining us on this webinar today, which we'll be looking at electricity market modeling, specifically the impact of variable weather on price risk, given there's a very dynamic market at the moment. So to get things started, just a couple of introductions. So I'm Andrew Groom. I am the Business Development Director for the Institute for Environmental Analytics. And I will be joined by a colleague of mine, Alan Yates, who is the Head of Energy Applications, and he'll be taking you through the story in a little bit more detail shortly. For those that perhaps are less familiar with the Institute for Environmental Analytics, we are a market-facing R&D organization. We have a particular specialism in taking on complex modeling challenges for organizations in the energy sector. Although we're an R&D organization, we typically work more towards the development end of that spectrum than the research side of things. We're trying to tackle real-world operational challenges. In terms of competence in the team, we have data scientists, software engineers, climate modelers, weather modelers, and we bring those skills to bear to develop new data sets, new decision support tools, new software solutions for our collaborators and customers in the energy sector. So given that we are seeing a strong energy transition, we have a lot more renewable generation coming into the generation mix. We started looking a couple of years ago quite seriously at the weather and climate-related challenges that are facing investment decision makers. Those individuals and teams that are looking at the merits of new solar and wind assets and trying to make sensible decisions about what it is they might do in this changing market with this energy transition ongoing and increasing volumes of variable renewable generation coming into the mix all the time. So this is the second in a three-part series of webinars that we've been putting together to report back really to the investor community and the developer community on what it is we've discovered, what it is we've learned, what we think the implications are really for investment decision making, and to try and expose some of the new technologies and data sets that could help with improving these investment decision making processes. So the first of these sessions was a little while ago, a couple of weeks ago, a month or so ago, and we started at the beginning of the story. We were looking at the practicalities really of working with weather data, with climate data, considering the current state of the art and thinking about what the implications were for resource, for solar and wind and related production. So now we're moving the story on. We're looking at the markets and really focusing on the impact that variable weather has on price formation. And from that, prices that assets can capture in the market, and of course, ultimately, the revenue and returns that these assets are able to generate. So that's what we're looking at in some detail today. And in the final session, which will most likely take place probably later this month or early next month, that will be completing the story with an exploration, a discussion into how some of the things which are fundamental to investment decision-making might need to evolve to start assimilating and integrating the new data sets and outputs from the sort of work that we've been doing here. Things like financial modeling and risk assessment. So that's the plan for today. There is a Q&A function which is enabled. So if you have questions, we would encourage you please to use the Q&A. We'll be tracking that as we go through the meeting. If something comes up which is burning, I'll interrupt Alan and we'll try and get a response to the question straight away. Otherwise, we'll leave some time at the end for Q&A to go through any questions that the audience has. But to begin with, before we get into the presentation, we've got a couple of polls that we'd like to put to the audience just to see where everybody is on some questions that we've got. So I'll launch the first one of those and we'll see what people's responses are to this first question. So first poll, where do you think weather variability sits in the hierarchy of all the risks and considerations that need to be taken into consideration when considering investment decision making? So some options there, very high up, high, somewhere in the middle, and low down. Got a couple of responses coming through already. Thank you for that. And we'll wait to see a few more responses and then I'll share the results. Okay. Still some responses coming through, so thank you for that. All right, I'll end the poll there and I will share the results. So interesting to see. A bit of a spread, really. I guess we would expect to see some, possibly some in the very high, but we'll see. as we move through the presentation, we may start to see a little bit of a change of opinion on some of those questions. So the next poll, which we'll do just quickly, is the second question. So given all the changes that we see in the energy system at the moment, and the fact that we've got many more solar and wind assets coming onto the system, lots more flexibility, a very dynamic system, do you see the importance of weather-related variability changing as this energy transition progresses? So if we can get some responses to those, will it become more important? Will it become less important? Or will it stay the same as your view today? I just need to try and launch this one. Okay, you should start seeing the poll coming through there. So question again, how do you see this changing as the energy transition progresses? Okay, some answers coming through. And I think this is... Okay, we'll stop the poll there. We've got quite a few responses coming through. Okay, so I think this is probably more in line with what we would have expected, which is, of course, as we see change in the generation mix, as we see more of an exposure to weather-related variability, this sort of thing is only going to become more important. So thanks very much for your contributions there. At this stage, I will be handing over to Alan Yates, who is our head of energy applications, and he'll be taking us through the rest of the session.
Hello, everybody. Great to be here. So I'm going to take you through a project that we've recently completed, looking at this question of how we better use weather data in investment decisions. So we know that there is a very significant capital investment going on. It's needed to reach net zero. And we're going to be bringing on very significant new capacities of offshore wind, in particular in the UK, but also onshore wind and solar, a big increase in battery storage as well. And as the volume of intermittent solar and wind in the system increases, then therefore market exposure to weather-related variability, we would contend, maybe doesn't become more important, but certainly its importance changes and evolves, and its impacts change and evolve. And our hypothesis, if you like, starting out on this project, was that weather-related uncertainty isn't well modelled by current methods and assessments that are in use by practitioners today. So we've had a lot of conversations around this topic with various modelers and organisations who are interested in the outputs. And if you're modelling an energy system these days, one significant question for you is, how do you represent weather? How is weather represented in your market model or your system model? And if, as we find in a lot of cases, it's represented by a single year, be it last year typically, or a typical meteorological year, or maybe a few cases of a good, a bad, and an indifferent year, you're probably not picking up some important risks that are going to become increasingly important in an evolving system. So we carried out this project for a set of stakeholders, including developers and portfolio owners, to try and come up with a better way of quantifying these risks and understanding some of these implications. So that's what I'm going to talk you through today. So we call it weather condition market modeling. What do we mean by that? Well, there's probably a 4-stage process that we go through. We start off with some weather, some time series of weather. We have to convert that weather into power, a step that we call weather to power. We simulate variable renewable energy, the VRE, and we feed that into a model of the system, which matches supply to demand, from which we derive prices. And then we match the prices to production from our assets, be it a single asset or a portfolio of assets. And we try to infer how much value those assets can capture. So 4 steps to this process, each of which are quite complicated in themselves. So it's quite a challenge to go end to end through that process. So before I go any further, I'm going to introduce you to a bit of terminology that I'm going to use in this talk. And it's important we get these concepts sort of clear to start with, otherwise life can get quite confusing. I will talk about hindcast years, or sometimes I might say weather years, and scenario years. So I wanted to distinguish between the two. If I talk about hindcast years or the hindcast year axis, we're talking about a long time series of weather data. If it's a hindcast year, it's been derived from something called a hindcast. If you're not familiar with that term, that's a gap-filled historical record of weather conditions, actual weather conditions. We could replace it with a climate view of the future, taken from a climate model. But in either case, what we will have is a long, multi-decadal time series of weather conditions, from which we derive demand, from which we simulate VRE, and from which we generate system prices. But to do that, we have to define the system. And we have another axis that I'll talk about, which is the scenario year axis. So our scenario years define the supply, the demand, the generation that exist in each year successively going forward into the future. So in our modeling, what we're going to do is we're going to take each scenario year in turn with its own supply, generation and demand, and we will simulate the behavior of that system against the weather year axis. So against the weather data, in this case, 32 years worth of weather data that's been derived from the historical record. So we do that for each scenario year in our simulation. So each scenario year is being tested against the same weather data, but it's a long time series with lots of variability in it. So that's the key point. I'll keep trying to re-emphasize that as we go through. So we've developed a weather and climate conditioned market modeling framework, which goes through a number of stages. We start off with that weather data, those long time series of weather data. We do some analysis on that, and we identify categorizations of weather conditions, similar conditions grouped together, which are distinguished from other categories, a clustering technique. And we also study the order in which these things occur. And we're primarily concerned about here with how long do conditions persist, because some conditions persist for a long time, others are more transitory. So we analyze that up front in our weather data. We then have built a supply model and a demand model, and I'll say a little bit about that in a minute. But these represent those behaviors in those states of our system in future scenario years, and they feed a series of dispatch models. In fact, we have 3 alternatives at the moment, 2 of which simulate a system which is controlled by a single system operator. This is not what happens in the actual GB market at the moment. It's a self-dispatch system, but a simulation which assumes a single system operator is a reasonable baseline for, let's say, a market arguably that is working quite efficiently. So it's like a base case or a baseline case or maybe a best case. And in these system operator simulations, we have 2 varieties. One is a single node system. In other words, all supply and all demand is connected to a single node, and we ignore transmission and constraints in the grid. And in the second version, we'll see we do consider transmission constraints, a multi-node problem. Quite computationally more complex, as we'll see, but it's an alternative way of modeling the system. Thirdly, we do have another way of modeling dispatch, which is still under development, where we try to model the behavior of individual agents, profit-seeking agents operating in the market, who are trying to always maximize their profit. So an agent-based model approach. We're not going to talk about that today, but it's still under development. However we dispatch, we come up with a series of price distributions, and we feed those price distributions into some sort of analysis of our assets, how our assets are generating, the correlation between the generation from those assets and the price distributions, and what value is derived from that. So that's the framework. And I'm now going to step through those stages one by one. So I talked about weather classification. We've used a cluster analysis on, in this case, an ERA5 hindcast data set. We've tried this in several ways, and at the moment, this is our preferred way of categorizing things. It's fairly straightforward. We take each season. You'll see that there are, if I can get my pointer working here, 4 seasons: winter, spring, summer, and autumn, and each season is divided into 4. We derive these from an unsupervised data analysis technique. So we ask an algorithm to cluster the days as it sees fit, and then we look at them and interpret them. And our descriptions here are describing what we found when that's been completed. And then for each one, we look at the conditions and we categorize them and describe them. So in this case, what you're seeing for one of our conditions, which is category 4 in summer, it's a composite here, weather map of the conditions that are associated with all the days in that cluster. And when this comes out, you can see, okay, yes, we see a nice pattern here. There's an anticyclone sat just in the North Sea. We've got low wind speeds. We've got very high temperatures and very high irradiance. That's how we can categorize the weather for that particular category of, looks like 607 cases. So we've done that for each of these conditions, each of these categorizations, and we'll come back to those in a minute. We feed the results from that into our dispatch model, into our supply and demand model, and then into our dispatch model. Unless otherwise indicated, from here on in, I'm talking about an ERA5 hindcast weather data set as a long time series, although it could be replaced by a climate one, as I've said. I've talked about the single systems operator dispatch assumption. We've taken into account minimum running levels on dispatchable resources, ramp rates, generation, and storage. We are trying to model, in this case, the day ahead market only. So we're not trying to model futures markets or the intraday market or the balancing mechanism. I will later on use the term system price in the slides, and I realize that might be confusing for some of you. The system price is not the balancing mechanism price. We're always talking about trying to model a proxy to the day ahead market price. And we're ignoring subsidies and incentives. The net result of those assumptions is that when you look at our prices, you won't see any negative prices. You'll see some 0 or just slightly above 0 prices, but you won't see any negative prices, and that's because of these assumptions here. Finally, for the panels that we're looking at today, we're assuming a flat price for all fuel types, for gas, biomass, and nuclear in the main. Totally flat through the entire time series. And we're doing that because, I mean, obviously the real world is not like that. And recently there's been very significant volatility in gas prices. But our focus of study in this was really about weather types and weather patterns and trying to compare between scenarios. And therefore we've rolled the pitch, if you like, so that when we're comparing one year with another, what we're seeing is weather impacts rather than, let's say, fuel price uncertainty and things like that. We've based this analysis on capacity assumptions, the scenario year assumptions about supply and demand that are based on the National Grid's future energy scenarios. The 2023 version, there's been a subsequent release since then. but this work predates the issue of the latest version. And it was the system transformation scenario. So basically, we wanted to emphasize the impact of renewables. So we went for the scenario option, which had most signal for renewables in amongst the noise. For those of you that aren't familiar with those scenarios, or this one in particular, here are some charts which show you the capacity assumptions. So this is the VRE capacity in the top left here. A very significant ramp up in offshore wind, a little bit of a ramp up in onshore wind, and a little bit of a ramp up in solar. In terms of the thermal capacities, we see a sort of gradual decline in CCGT capacity, a bit of a drop and then a rise in nuclear. Over on the storage side of things, we're seeing a very large assumed ramp up in storage, basically BESS, battery energy storage systems. And the interconnection assumption in this scenario is that the GB system goes from pretty much a neutral or slightly positive importer of energy from the interconnectors to becoming a significant exporter by 2040. So a gradual transition there, but a significant transition. In terms of the scope of this model, we're modeling the GB network and the GB markets. We have interconnectors represented in the model, but only as a fixed entity. So we schedule the imports and exports to fit this profile, rather than model the whole of Europe and intermarket effects. So an important thing to understand, but the import and export assumption is as we see here. In terms of demand, some colleagues of ours in a consultancy called Safe Earth Solutions created a demand model for us, which is a weather and fundamentally a temperature-dependent demand model. We needed something which allowed us to take a set of weather conditions and derive an expected demand given socio-economic assumptions about the future. So how many heat pumps are going to be used and how many EVs, and structural changes in the market, things like that. So they performed an exercise of picking out some socio-economic trends and also some weather-dependent regressions effectively. Put all those together, and we end up with a way of being able to come up with a weather condition demand estimate for all of the hours in our scenarios. And it's actually quite complex to give you a visual representation of what's going on in this in this demand picture, but here's one way of looking at it. We're looking at across that hindcast axis that I was talking about, across the 32 years. For each scenario year, we take the assumed demand. I think this is the monthly maximum. So in every month, the maximum demand that there is. So there is a bit of seasonal profile within a year. And then over time, we see the peaks rising in accordance with the FES. If you want to zero in on, let's say, particular hours in our hindcast, so remember I'm saying for every hour in a hindcast, we need to be able to say, given the weather on that particular day, let's say the 2nd of January 1991, if you had the systems of, let's say, 2021, 2022, and so on, all the way up to 2040, this would be the demand that would result. So that's what you're seeing in these rippling line charts up here. There's a gradual increase in demand for each successive scenario year, hour by hour throughout the hindcast. And I'm showing you January and just for comparison, August. So lower demands in August, and you can see the typical pattern of weekdays followed by weekends in this data as well. We're looking at 1 week here with a number of weekdays and then a couple of weekends, and then we're back to the week. So all of these things are represented in that demand data. So we take the demand, we take the supply assumptions, and we schedule, we dispatch, we use a standard unit commitment problem, as it's called, approach, using mathematical solvers to try and work out how our systems operator would deliver to minimum cost. simulating each scenario year against the same 32 years of hindcast data. And then we look at the results. And we can look at the results in a number of ways. Here, what I'm doing is I'm picking out those days in our hindcast, which are, we've categorized them as cold and calm. This is your typical Dunkelflaute, as it's called, in winter, cyclone, an anticyclone sat over the UK. It's very cold, there's no wind, it's a bit gloomy. So that's the classical Dunkelflaute. And then what I'm showing you here is the distribution of the day-ahead market prices that result from our stylized model. And you see these peaks, the peaks and the troughs here are representing our assumptions about the marginal cost of generation of different types. So CCGTs probably around here, OCGTs at the top, and wind and solar, if it becomes the dominant price setting generation, would be down here at the bottom. And as we roll through our scenario years from 2022, we can see we start off with a fairly high price regime here. As the years go by, there is a bit of a contribution more from lower marginal cost generation from wind. Not much though, because it's a Dunkelflaute and there's not much wind around. If we look at a different example, this is our category in winter of windy, warm and cloudy. So this represents conditions where we have cyclones passing over the UK, possibly in quick succession, high pressure gradients, high wind, bit warm, very windy, quite cloudy, a lot of cloud moving around. So if we look at those days and we compare those, again, we see a strong tendency towards gas-fired generation in 2022. But then as we move forward and roll through the scenario years, as more offshore wind is connected to our system, the distributions start to shift. And because it's windy conditions, they start to contribute a lot of wind power into the system, and the marginal cost of wind is very low. So we start to see this growing frequency of occurrence of low prices as we move forward through the years. And remember, these years 2040 or 2034 through to 2040, we've got quite a strong exporting assumption built into that scenario. So some of these prices in the mid-range here are probably being supported or generated as a result of that. And if you took that away and made us a neutral or importing system, this distribution would change quite significantly. So I mentioned our categories and I mentioned the sequences in categories. So here's an example where we look at the sequencing and the categories, and we're looking for persistent long conditions. So the color coding up here, that Dunkelflaute condition that I'm talking about, is represented by the orange squares, an orange square for each day between January 1991 weather, 22nd of January 1991 through to February 1991. A long sustained Dunkelflaute, maybe breaking up a little bit towards the end. So high prices, low wind, very low temperatures, high demand. And this particular case is a very long persistent case in those conditions. And we'll come back to this at the end of our presentation as to what that means economically. This is an equivalent, but just for the summer equivalent, boiling hot conditions, Lucifer conditions. But again, we've picked a point out of our weather series where we can see that there is a very long persistence of those conditions. So I think it was someone from one of the chiefs of National Grid was talking about how their point of view is changing in terms of what they look for in system resiliency. It used to be all focused on the worst hour that you can consider in winter in a Dunkelflaute. Make sure we've got enough reserve to cover that. Now the move is more moving towards how long will those conditions, what will be the shape of those conditions and the frequency of those conditions be. So this is the sort of thing we're starting to look at here. And if we look at those persistent conditions, and we take all the what we call high price conditions, and look at how long they run for, we can see that there are shifts in that distribution as well. So In this modeling, if we look at the high price run lengths, so a long persistent duration in hours of high price conditions, situation in 2022 was, well, a very high frequency of very low run lengths. You probably can't see very well on here, but there's the gray histogram continues underneath the yellow one here. This was the situation back in 2022. But when we repeat exactly the same weather, but in 2030, the distribution of the price run length shifts, and the distribution is moving towards the right in general. But there is a very, very long tail in this distribution. In fact, it goes way far off to the right of this slide. So there's things going on in this area that I've just highlighted with this square. And if we focus in on that only and look at the behavior in the tail, we can see that there is something different going on in the tail. So the shift is pushing back in the other direction in the tail. So if you're concerned about extreme conditions, that's something to bear in mind. The general shift may be in one direction, but the tail behavior is different. We don't have a great explanation for this at the moment, but it's something we might investigate going forward. So those results, they all came from a single node model, unconstrained, which produces a single system price for the system, for the GB system. Early on, our stakeholders said, well, this is all very well, but we're getting curtailed a certain amount of the time, and we really do need to factor in curtailment. So can you do anything about this? So we thought about the problem. We looked at the national grid, which is represented in this middle chart here by the red lines. That is the national grid. And National Grid also, ESO, also issue information on boundary constraints or assumed boundary constraints from their 10-year forward look ahead. So these are bottlenecks, known points of restriction in the network that we need to factor in. And there are time series of capacities associated with each of those, and which change as the system is reinforced. So we want to somehow represent the impact of those boundary conditions, and our attempt to do that is represented on the right-hand side here. So we've changed the red actual national grid into a simplified black nodal network over here, with nodes situated in regions of the country. So it's a zonal model, really. And the nodes are connected by edges. The edges cross the boundary constraint and therefore get subjected to the constraints of transfer over those boundaries. So we're not claiming this is, the perfect way of representing it, but it's something we came up for the means of demonstration. So we apply all those constraints. We apply the generation and the supply in each of the nodes. We apply the constraints across the boundary, and we use a technique that's called DCOF, or DC optimal flow. Without going into all the details, it's a technique that's used to clear some zonal markets in Europe and the US, I believe. We've tested the algorithm that we generated for this against one of those European markets, and we assured ourselves that the mechanics of it were working. We needed to validate it against something, and the only thing we could think of was validating it against the curtailment actions as they stand today of the national grid. So we went to Elexon and pulled out from their curtailment and constraint actions from system operator instructions. That's represented in this bottom chart here on the left by the red line. That is actual curtailment and going on. The blue line is what our model is suggesting when we look at a historic period of time back in 2022. Now, at first sight, you might look at that and say that's not a very good correspondence. Certainly in terms of the magnitude, it's not a good correspondence. And there's a number of reasons why that might be. But what we're more concerned about really is that, are we getting curtailment happening at the right times and in the right places? And you can see from this plot that actually when there is curtailment happening in the real system, we are picking it up in our model. And it's coming up in the right places where you would expect. In other words, across the B6 boundary, which is here. And in later years, when we've got lots of wind power out in the North Sea, constraints kick in around this link here into the high consumption areas in London. So we are reasonably happy that this is working as an illustration. Life gets much more complicated when you move into a multi-node model. It blows your mind. This is one slice, 1 hour out of one of our runs. The data volumes and the complexity and the run times all explode quite significantly. You won't be able to read probably the detail on this slide, but here's our simplified national grid. And for each node, there is a story. There is some demand at a node. There's some generation, some exporting or importing going on. Might be some load shedding, but not in this case. We haven't had to do that, so that's good. What we're looking for is these red numbers. You will see occasionally there's a red number here and here, which says our solver is saying you should curtail at this hour. So the curtailment is what we were looking for. Along the way, we thought we might as well calculate some marginal cost at each node. And you can see this is the north of England. We've got the south as well. There are some definite differences in nodal prices assumed by our model, given all those assumptions about the marginal cost of operating the generation stack. So we're going to leave it to REMA to work out the best way to design the market in future, but there's obviously a lot of interesting phenomena and significant things to consider there. So we've done some dispatch. We dispatched our proxy for the day-ahead market. So what? What difference does it make? Why should we be bothered? And why should we be using these long time series of weather data? What difference does it make? So I want to explain this with a little example, simplified example, to highlight the main point. So let's say we're a wind developer. We've got a portfolio of wind in South Wales, and we want to, or maybe we're about to develop that portfolio, and we want to understand how much value we might capture, and we might be considering some different PPA structures. So PPA means power purchase agreement. It's a long-term forward agreement to purchase power at an agreed price between an off-taker and a supplier. If you're evaluating deals, you need a baseline to measure against, and you might use as your baseline simply selling your energy, all your energy on the merchant market. So selling it on the day-ahead market, which would give you a benchmark, I guess, for what you might expect to generate from your asset. So that's the merchant option. Most likely, in the absence of any other subsidies, you would be looking historically for what's called a pay-as-produced PPA. So in a pay-as-produced PPA, there is a fixed price for every megawatt hour that you produce, and you've found an off-taker that will pay you that price and take the price and volume risk. So the risk that arises from your wind farm not generating at a particular point in time, or generating at a time when market prices are low, is taken by the off-taker. And historically, this is what developers would look for, and many financiers will only finance if you've got some sort of pay-as-produced or other subsidized mechanism in place. That's what guarantees you, gets you the finance to build your wind farm or your portfolio. There is another option, increasingly, well, not increasingly, but maybe in the future, baseload deals might become more relevant. So if the market appetite to take on, for the off-takers to take on the price and volume risk dries up, then they might want to only offer, for example, a baseload deal. So in this case, our wind farm operator would have a fixed volume commitment. If the wind farm doesn't meet that commitment, the seller has to source the deficit from the open market. So there is a baseload commitment. Let's say the gray area here is showing you what our wind farm is producing. That's sold to an off-taker at an agreed rate, so we can get some revenue from that. If we happen to generate more than that, we can sell that at the day-ahead market rate, make some more revenue from that. But if we don't deliver in any hour the required power level, we have to source the deficit on the open market and pay for it. So that represents a negative cash flow and a risk. So that would be a baseload deal. So if we take an assumption, we created an example around a baseload deal here where there was a baseload commitment of 50 megawatts, some market price assumptions about what we could sell that energy for in a baseload deal, but then take into account these residuals. So any negative cash flows from the deficits and any positives from the surpluses. So this is where we would run that against our hindcast data, weather data axis against, in this case, the chart is showing you the cash flow for every month across our weather axis for the scenario year of 2022. So an undulating line, month by month in sequence through the entire hindcast. And we'll see there are peaks and troughs. And if you go and look at them, you'll see these troughs are associated with those long period adverse conditions. For example, those Dunkel flouters. You can also see there is an upside. There are some peaks when there's financially advantageous conditions and a lot of fluctuation between the two. So this would be our situation simulating against all the years in our hindcast for 2022. So now let's move forward to 2030. So we've now got much more wind power connected to the system. The red line now is showing you how exactly the same data generates a slightly different cash flow to the blue line. We've still got peaks and troughs. You can see there's a sort of general shift downwards. The troughs get lower, the peaks get shaved a bit. We could take our blue line, so this blue line here, and order it. So we take exactly the same data in the blue line in the top graphic, and we order it from maximum monthly net revenue on the left-hand side, which was 4 million in a month, and then put it in order, descending order of magnitude all the way down like this to the worst month financially in our 2022 case. So that's one way of rearranging that time series. If we do the same thing for the red time series, we see now then this clear shift downwards, probably a result of cannibalization in our system, all that wind power coming on board. But now what we can see is an area where we have got some distinctly negative cash flows. So it's possible that there may be some months where there are very significant negative cash flows. If I put the distribution of these cash flows from the hindcast and just compare them here in 2022 between 2030, again, we can see that there is a series of months where there are seriously negative cash flows. So this represents a risk, and this is the sort of thing that is in the mind of some of our stakeholders about what is that risk? Should we be staying at night worrying about it? How do we manage it? There is, of course, as Andrew will remind me, an upside risk as well at the other side of this line up here. But really, we need to quantify that risk because in the wrong circumstances, that can drain your cash very quickly. It can lead to basically your business going bust or your special purpose vehicle going bust. Remember, we've got a fixed gas price assumption in here as well. So if we put in on top of this peaks and troughs from gas prices, a confluence of very high gas prices with those conditions would really, well, that would leverage those impacts quite considerably. So you can only really pick this out if you use long time series of weather data or long time series of climate data using hundreds or thousands of weather cases, which is effectively what we've got here. This is the only way you will get them. If you use a typical meteorological year or you select a year at random, you might not see this effect at all, or you might see it and overemphasize it. So you really need the long time series to be able to quantify these risks and put them in some context. Just one final point then. People always ask about using hindcast data. That's historic data, but climate change means the weather is changing in future. So we did a whole webinar on this, which we should send a link to for people to look at if you're interested in the climate change aspects of this. But cutting a long story short, because I'm a bit short of time, we reran our categorizations that we performed against our hindcast in the blue here, and we ran those against the conditions that were pulled out of one of the climate models, UK CP18, a UK Met Office model, using the RCP 8.5 assumption. See the previous webinar for what all that means. But this is a plausible climate future. And if we look at the difference between the blue and the red bars here, we see a change in frequency. And if we look at the Dunkelflauters, this is saying that they are looking like they will be becoming less frequent, or the high price conditions will be becoming less frequent. The anticyclone in summer conditions, this is climate change, this is global warming, this is very hot conditions becoming more frequent, quite a significant trend there. But these two effects might operate in counterbalance to each other. The rider out of the previous webinar was that this is very interesting from the point of view of this climate model, but if you run other climate models and other conclusions are available. So there is some uncertainty that needs to be dealt with there. So that's been a gallop through, and I think I'm going to hand back to Andrew to take us through the Q&A. I'm going to just need to, there's my window. Bear with me one moment here. There we go.
Okay, thank you very much, Alan, for taking us through that. Quite a lot of ground we've covered there. So hopefully that's been interesting for our participants this afternoon, and hopefully also informative. So if anybody wants to follow up on any of that and get in touch with us to talk through any of these results or any of these activities in more detail, there's a contact address on there. As Alan mentioned, we'll package up the session today, put it on our website along with all the other webinars we've done recently, so you can get at the material in that way if you want to refer back to anything that's been said. But just to close things off, we've got one other poll that we'd like to run with our participants just to see, given that we've covered quite a lot of ground there, we started up with a fairly mixed set of perspectives in terms of the importance of weather-related variability for these investment decision-making processes. And we also had the expectation that these things would become more important in the future. But we'd like to just test the water now with one final poll before we get onto the Q&A itself. And that is, if I can just get this poll launched here, we'll get to that question in a second. So given what Alan's just gone through, there's some interesting things there in terms of how things might be done differently with longer time series of weather data and more insights coming out in terms of potential upside to attract the attention of equity investors, potential downsides, which could be properly hedged and properly presented when talking to lenders in order to attract a lower cost of capital. So some potentially material things coming out there. So given that, interested to get people's views now on the extent to which you think it might be worthwhile to rethink or reevaluate really how weather-related variability is being integrated into your investment decision-making processes. Already got some responses coming through there, so if everybody can make a selection there, that would be good. Okay, so we've got quite a strong set of responses coming through on here. Just 1 or 2 more moments for the last few answers to come through, and then I'll share the results on that. And again, not surprising, really. There's clearly a big shift, really, in terms of how the energy markets are evolving. A lot of this weather-related exposure is going to become a lot more acute, and there will be a requirement to start thinking about these things in more detail and understanding these risks properly and getting a proper set of insights around them. So not unsurprising to see a shift towards these things becoming more important in the future. So stop sharing that one. We have got some questions that came through whilst Alan was presenting his talk. So we'll go through those now, just as a Q&A to finalize things. And then, as I say, we'll package up the webinar. There'll be a recording that'll go out. And if there are any questions which we don't have any time to go through now, we'll put some responses together for those and include those along with the recording itself. So Q&A starting shortly. Okay, Alan.
Yep.
First question is not unsurprising and is a useful one. So you talked about hindcast data. There's a question here around the relevance of doing this kind of modeling with hindcast data. So we've got a backward-looking perspective when we're talking about hindcast data. We've got a long time series, but given that the weather is evolving with climate change, and investment decisions that are being made now are for assets that are going to be operating over lifetimes for a long time into the future, how representative really is historical weather data for these kinds of forward-looking investment decisions?
Yes, so we did a whole webinar on this. So we really should post the link to that previous webinar for people to look at that. All that I just described there can be redone using climate model data. So long time series extracted out of the climate models. There are many climate models, and they don't all agree for good reasons. So I would refer you to that webinar for all the sort of considerations that there are around that. I think what it implies is you really probably do need to take an ensemble approach and take several views of what plausible long time series of weather data might be relevant in future, and build your analysis up from those.
Okay.
But having said that, I think it's still true to say that a high degree of the variability that's been found in the weather in the last 30 years is still going to have a reasonable persistence for at least, a decade. So I don't think you would completely throw the hindcast away completely.
Okay, so some value still in using hindcast, but preferable to use a longer time series. But there is now the potential to flip that around and actually use the output from a climate projection,
Yep.
even if there are lots of different flavors of climate projections to provide a more forward-looking view. Thank you very much. Another interesting question. You talked about tails a little bit when we talk to investors in the context of this kind of market modeling. People often talk about fat tails. There's a question here around fat tails. What are they? And to what extent should people be concerned?
Okay, so fat tails, in my mind, if you think of the normal bell-shaped curve that's talked about, the normal distribution where you've got a low frequency at one end, which builds to a peak and then comes down to a nice smooth symmetrical curve down at the far end. So that is a standard shape. And I think when we're talking about fat tails, is talking about the extremes, which are normally extreme values, which are very infrequent, become slightly fatter than that standard shape suggests. So there's more frequency, a slightly higher frequency in the tails. And if you're interested in extreme events, if extreme events are what, for example, creates damage in the system, or in the case of what we're talking about, persistently adverse financial conditions, if those very infrequent but very damaging conditions increase in probability by a factor, they might double. They're still very infrequent, but it's double a very bad, significant outcome that you need to consider. So fat tails are something that people want to keep their eyes on.
And those price distributions we saw on one of your earlier slides, where we start to see these multimodal peaks, is that indicative at all of a change in the shape of these tails, and the fact that these low probability, high impact events could actually start to become more frequent and therefore merit some more attention in the risk management processes?
Well, I mean, I think that the distributions that we're trying to produce are the whole point of doing this sort of analysis is to create an accurate representation of what the distribution in prices and therefore the variability is. They're quite complex. They're not a nice, simple bell-shaped curve, as you say. They're multimodal and they've got lots of different peaks. So the whole purpose of doing this is to try and produce an accurate representation of that uncertainty as far as we can, based on well, either historic data or climate perturbed data. So I don't know about the fat tails thing. The key point is there's a particular concern around very infrequent events that have a very significant impact.
Yeah.
What's happening to the probability of that? Is it going up or down?
Yeah. Okay, good. Another question here. I mean, you talked a lot about using longer duration time series of weather so that we could produce lots of different scenarios. We could go through thousands of simulations to start to quantify some of these risks a bit better than, for example, if you're just using a typical meteorological year or some sort of sampling on your weather years. People are familiar with Monte Carlo simulations, and this is what people often do to generate a distribution. There's a question here around, we use Monte Carlo distributions. In this way, we can create many thousands of different scenarios. So what is the difference there? Is there anything we can say about what the difference is between a typical Monte Carlo-based approach and what you've just described?
Well, I think in a way what we are describing here is a Monte Carlo-based approach. It just so happens that we're using long time series to generate many repeated cases of data that we use to build up into a statistical output, a stochastic output. The question in my mind is that this is one dimension of uncertainty, but then you've got, for example, fuel price uncertainty, and then there are all sorts of other risks, counterparty risk, regulatory risk, and I think your full-blown Monte Carlo techniques would be sampling in all of these dimensions. So I don't think we're recommending a huge change. It's more a development of and more prominence to the weather variability.
So that the input to your Monte Carlo simulation is capturing this underlying weather-related variability better than perhaps your typical approach would today.
Yeah, along with all the others. Yeah.
All right. Another question here. We talked about least cost dispatch, and we had three different ways in which we could produce a dispatch and produce a price outlook. A couple of them were least cost dispatch. There's a question here around how valid that is an approach, given that that's not actually what happens in the real world markets. How valid is it to be using a least cost dispatch to start trying to understand these price outlooks?
Yeah, well, I think even though it is a theoretical, in the context of GB, it is theoretical. There are other markets where a systems operator does operate to least cost dispatch, or operate to least cost. But even in the context where you don't have a single systems operator scheduling all the generation, it's still it's like a baseline. It's a standard that you could aspire to. Supposedly, I think an economist would say that a perfectly functioning market would deliver you a least cost outcome. So we're taking all the other factors that get in the way out of that by saying we've got a systems operator that is honestly trying to get to a least cost solution. That would be probably the best you could do, you know. So it's a baseline, it's a reference. And then, as I described, we have this other line of work in terms of agent-based modeling, which is trying to then develop that further and say, okay, what are the implications for market players who are self-dispatching, who want to maximize their own profit? How would that work and what would that lead to?
Okay, very interesting. So that agent-based work is still in progress, I think you said, but there is, potentially an emerging technique there would help us understand profit maximizing behaviors and something which is perhaps more representative of a real world market than a traditional least cost dispatch. Okay, thank you very much, Alan. That's been really interesting. We've run out of time for this session today. So just to remind people, we will send out a recording to those who participated, and we will make a recording and a package available on our website under the Knowledge Hub with all the other webinars that we've done. So thanks very much again for participating, and hope to see you on the next session.